Welcome to the Explainer. So, what if the next massive financial event isn't some stock market crash or boom, but a total reset of our money itself? Today, we're digging into the analysis of Mike Maloney, who argues that precious metals are flashing some serious warning signs that that's exactly where we're headed. Okay, so let's just start with the headline claim from our source material because it's a huge one. We are not talking about silver going up 10 or 20%. The argument here is that we are on the verge of a historic revaluation of what we even consider money, and it all kicks off with silver. So you have to ask, right? What on earth would make someone come out with such a wild prediction? Well, according to the source, the whole thing was triggered by a very specific, very powerful breakout in the price of silver, which he projects happened back in August 2025 to frame this analysis. Now, sure, the daily price popped to levels we haven't seen in almost 14 years, but Maloney says, that's just market noise. The real story, he argues, is in the closing prices. And here's the part that's just staggering. He claims that on a quarterly and annual basis, silver just locked in its highest closing price in 2,500 years. To him, a move like that isn't just a blip on a chart, it's a tectonic plate shifting under the financial world. But look, a crazy chart pattern on its own doesn't just change the world, right? There has to be something fundamental driving it. And this analysis points to three key signals that suggest this isn't just some temporary spike, but the beginning of something much, much bigger. Signal number one, and this is a biggie, is what's called remonetization. It's this idea that silver is starting to be treated like real money again. The source points to central banks like Saudi Arabia and Russia actually buying physical silver for their reserves, something we haven't really seen in decades. And it's not just happening at the national level. States like Florida have passed laws to legally recognize gold and silver for transactions. Okay, signal number two gets a little technical, but stick with me because this is important. It's a rare condition that pops up in the futures market, and it's basically a giant flashing red light that signals an intense, almost desperate demand for the physical metal. And that condition is called backwardation. All it really means is that buyers are so eager to get their hands on physical silver right now that they're willing to pay more for it today than for a contract promising to deliver it in the future. That kind of urgency screams one thing: a mad scramble for physical supply is underway. And to really get why this is such a big deal, you have to understand this is the complete opposite of how the market normally works. Usually, it's in what's called contango, where future prices are higher to account for things like storage costs. Backwardation flips that whole script upside down. It's a clear sign the market is under some serious physical stress. And the third signal? Well, it comes from the U.S. government itself. Silver has now been added to the draft list of critical minerals. That's an official stamp saying, hey, this stuff is really important and its supply is at risk. And the real danger here is that most silver isn't mined on its own. It's just a byproduct when companies are digging for industrial metals like zinc and copper. So think about it. If the economy slows down, that mining activity could grind to a halt, choking off the silver supply right at the exact moment monetary demand is going through the roof. And if you're wondering just how explosive this could be, get this. The source claims that the total value of all the silver ever mined in history is less than the market value of one single company, like Amazon. Just try to imagine what happens when even a tiny fraction of global wealth tries to pile into a market that small. But here's the thing. This story isn't just about silver. According to this analysis, silver is really just the canary in the coal mine. It's the early warning sign for a much bigger trend, a global institutional stampede into physical gold, all driven by a creeping fear of paper assets. And listen, we are not talking about your uncle buying a few gold coins here. We're talking about massive structural demand from huge players. China has reportedly mandated its insurance companies to buy physical gold. Pension funds in India are looking at it. Entire countries like Indonesia want to stop exporting gold to keep it inside their own borders. This is a big, coordinated move toward hard assets. And this all leads us to what might be the most crucial and, honestly, the most jaw-dropping part of this entire thesis: the insane disconnect between the physical gold that actually exists and the mountain of paper gold that's traded on financial markets. According to the source, the ratio of paper promises to actual physical gold isn't 2 to 1 or even 10 to 1. It's estimated to be as high as 100 to 1. Let that sink in. For every single ounce of real physical gold sitting in a vault, there could be 100 different paper claims, all pointing to that same ounce. So how is that even possible? It's done through a process with a fancy name: rehypothecation.
But just think of it like this. It's like a bank taking a single gold bar and using it as collateral for 10, 20, 100 different loans, all at the same time. Every lender thinks they have a solid claim to that gold, but it's really just a fragile web of promises. You see, this whole system, this entire house of cards, relies on one thing and one thing only: confidence. It all works just fine as long as nobody actually asks to see the metal. But what happens when people start saying, "Show me the gold"? The source argues that if even a tiny fraction of those paper holders demand delivery, it would trigger a gold panic, a run on physical gold that simply can't be satisfied, forcing the price to snap to its true, unsuppressed value. So all these threads, the silver breakout, the institutional gold rush, the paper market leverage, they all weave together into one final and really dramatic conclusion. This isn't just about a bull market in metals. This is about a fundamental reset of our entire monetary system. From this perspective, you've kind of got it backwards if you think gold and silver prices are going up. What's really happening, he argues, is that the currencies we use to measure them, the dollar, the euro, the yen, are going down. Gold and silver are just the yardstick that's revealing how much value our money is losing. And if you think that sounds like some far-off, abstract theory, the source says to just look at what's already happened in a place like Venezuela. After hyperinflation completely destroyed their currency, what happened? Supermarkets reportedly started pricing everyday goods not in worthless believers, but in grams of gold. Maloney presents this as proof of what he sees as a universal, historical truth. Whenever people lose faith in the money their government prints, they always go back to real, tangible money that can't just be created out of thin air. And that really is the heart of this entire analysis. It leaves us all with a pretty provocative question to chew on. If the currencies that we work for and save in are constantly falling in value, then what is the future of money? What is real wealth? And how will we even measure it?